There is a sentence that was spoken on national television this week that almost no one in the retail crypto market actually heard correctly. It lasted 4 seconds. It contained no price target, no token name, and no prediction. And yet, inside the walls of every major asset manager in the United States, that single sentence triggered a quiet repositioning that has not stopped since. The man who said it is not a trader. He is not a permabull. He is the chairman of the agency that spent the last decade making this industry's life difficult. And what he said was not a forecast. It was a deadline. 2 years. That is the window. A timeline delivered on camera by the head of the SEC. And the moment those words left his mouth, the entire institutional clock on this market changed, even if your portfolio does not yet show it. Make sure to like and subscribe, and drop a comment below with your opinion on XRP. And watch until the end, because the final minutes reveal why July 13th could change everything. Welcome back. I am the Calm Analyst. Today, we are not reacting to a clip. We are decoding what that clip actually authorized, what it greenlit behind closed doors, what it accelerated on the OTC desks, and why the next 24 months will look nothing like the last 24. No hype, no noise, just the architecture underneath the announcement. Let's go under the surface. Let's start with the hard truth. 95% of the people who watched that interview heard a forecast. They heard a man in a suit speculating about the future. What they missed is that the chairman of the Securities and Exchange Commission does not speculate on national television. He communicates. To understand what was actually said, you need to understand how regulatory communication works at this level. When the head of the SEC tells a national audience that tokenization is coming maybe in a couple of years, he is not making a prediction. He is publishing a policy direction, a signal to every general counsel, every compliance officer, and every custody desk in the country that the agency's posture has officially flipped. Retail investors heard a man being optimistic. Institutions heard a man removing the last legal excuse for delay. This is the mechanism that almost no one is explaining. Behind every public statement at this level sits a private framework, a coordination layer between the SEC, the OCC, the CFTC, and the major banking regulators. When the chairman speaks in public, that framework has already been negotiated in private. Larry Fink does not move $10 billion on a hunch. Jerome Powell does not approve infrastructure shifts on a vibe. These institutions move only when the legal runway is paved. What Paul Atkins did this week was confirm, publicly, that the runway is finished. The clearance has been issued, and the planes that have been circling this market for 3 years are now beginning to land. This is why XRP matters in this conversation, even though the chairman never mentioned it by name. Because tokenization at the scale he described, global financial settlement migrating onto blockchain rails inside 24 months, is not a Bitcoin use case. Bitcoin is a store of value. Tokenization at institutional scale requires a settlement layer that is fast, deterministic, regulated, and built specifically to move value across jurisdictional borders. There is exactly one publicly traded digital asset that has spent 13 years being engineered for that role. That is the foundation. Now let's look at the math. Here is the math that the retail crowd ignores. The global cross-border payments market is roughly $150 trillion per year. The daily foreign exchange market is approximately $7.5 trillion. The tokenized real-world asset market, the specific market the SEC chairman was describing, is projected to absorb between $4 and $16 trillion by the end of this decade. As of late 2025, only about 8 to 9 billion in tokenized treasuries exists on-chain. That is a rounding error against a $30 trillion treasury market. Now overlay the supply side. XRP has a fixed total supply of 100 billion tokens. Roughly 55 to 57 billion are in circulation. Ripple's escrow continues to release 1 billion per month, with the overwhelming majority re-locked. And here is the figure that almost no one is publishing correctly. Coinbase's exchange-held XRP supply has dropped by approximately 45% in recent weeks. OTC desks, by some institutional estimates, absorbed close to 800 million XRP in the first weeks following the spot ETF launch. We cannot independently confirm that figure, but we can confirm the direction. Exchange reserves are draining. ETF holdings are climbing. And the public price has not yet repriced the imbalance. Let's run the calculation. If the tokenized RWA market reaches even $4 trillion in the timeframe Paul Atkins described, and if XRP captures even 1% of the settlement flow attached to that market, you are looking at $40 billion in annual transactional volume routed through an asset whose liquid float on exchanges is collapsing. 40 billion against a shrinking float. That is not a prediction. That is a pressure equation. This isn't a moonboy fantasy. It is a design requirement. If you want to move trillions of dollars of tokenized value through a settlement network, the unit of account on that network cannot remain at $2. The math will not allow it. The system itself will not allow it. The math doesn't lie. The only question is, who is positioned before the equation resolves? While retail investors are panic selling because the price has not moved, the institutional signal has never been stronger. Look at the evidence that arrived in the same window as the SEC chairman's statement. Bank of America, $2 trillion in private bank and wealth management assets, formally authorized 15,000 advisors to allocate 1 to 4% of client portfolios into regulated digital asset ETFs starting January 5, 2026. That is not a pilot program. That is a directive. Spot XRP ETFs crossed 844 million in assets under management in under 3 weeks, with Paul Barron and on-chain trackers projecting a clean break above 1 billion before mid-December. Canary Capital filed an S1 for a multi-asset American crypto ETF that includes XRP directly, not derivatives, direct holdings. And Open Eden, a leading tokenized real-world asset platform, just closed a strategic round with Ripple as a participating investor, with tokenized treasury infrastructure being built natively on the XRP ledger. Ask yourself this brutal question. Does Bank of America move $2 trillion worth of advisor authority without absolute legal certainty? Does BlackRock's Larry Fink reverse a decade of public skepticism on national television without knowing exactly where the regulatory floor sits? Does Ripple invest into tokenized treasury infrastructure without knowing which ledger those treasuries will eventually settle on? These institutions don't gamble, they position. And the positioning is happening in plain sight for anyone willing to read it. The retail crowd is staring at red candles and complaining. The custodians, the market makers, the sovereign-adjacent funds, the central bank advisory committees, they are signing NDAs, writing custody agreements, and absorbing supply through channels you will never see on a candlestick chart. This is not retail FOMO. This is calculated repositioning by the actors who already know the calendar. So what is the calendar? January 5th, 2026 is the first hard date. That is when Bank of America's advisor allocation goes live. 15,000 advisors, $2 trillion in managed wealth, formally cleared to recommend regulated digital asset exposure. Even if only a fraction acts in the first quarter, the absorption will be measured in billions. The Digital Asset Market Clarity Framework continues moving through the legislative pipeline, And based on current signals, final structural clarity on token classification is expected to land within the first half of 2026. That is the moment the risk premium attached to XRP, the discount built into the price because of years of regulatory ambiguity, vanishes. Second quarter 2026 brings the next ETF expansion wave. Multi-asset crypto ETFs, the Canary structure, the Franklin Templeton structure, and the products BlackRock has not yet formally announced but is almost certainly preparing, open a second institutional channel that did not exist this year. And underneath all of it sits the 2-year window the SEC chairman publicly committed to. By the end of 2027, if his timeline holds, tokenized financial infrastructure becomes operational across major banking and brokerage networks. Not theoretical, not pilot phase, operational. When the Clarity framework finalizes, the wait-and-see capital becomes all-in capital. The fuse is already lit. The question is only how much oxygen remains before ignition. We are moving from an era of abundance to an era of scarcity, and most of the market has not noticed yet. Think about what is actually happening to the float. ETF issuers are absorbing XRP and locking it into custody structures that do not return tokens to the open market for short-term profit-taking. OTC desks are draining supply through channels that never touch the visible order book. Coinbase's exchange-held XRP has fallen by nearly half in a matter of weeks. And institutional custody arrangements, the multi-signature cold storage vaults that hold tokenized assets for sovereign and corporate clients, operate on a one-way valve. Tokens go in. They do not come out for a 10% rally. Once the regulatory gate fully opens in 2026, the entry queue becomes a wall. The institutions waiting on the sidelines will not be able to acquire meaningful positions through the open market without moving the price against themselves. They will have to compete for whatever supply remains on exchanges, and that supply is shrinking every single week. The window where retail investors can accumulate whole tokens at current prices is not theoretical. It is closing in real time. Once the final regulatory switch flips, the gap between today's price and the price required to support the settlement load will not close gradually. It will gap. The institutions have spent years patiently waiting for the conditions to be perfect. Now the conditions are forming. And the only people not paying attention are the ones who will become the exit liquidity that funds the entry of the informed. I know what it feels like to watch this market right now. The price has not reflected the news. The headlines create fear. The chart looks tired. And every short-term signal seems to contradict the long-term thesis. But as an analyst, I am trained to distinguish noise from signal, and the noise right now is deafening for a very specific reason. Red candles are not weakness. They are the smokescreen that allows quiet accumulation. FUD is not an accident. It is the psychological pressure that shakes weak hands loose so that stronger hands can absorb their position at a discount. A flat price during accelerating institutional absorption is not stagnation. It is the silence of a predator that has not yet decided to move. Being early feels exactly like being wrong, right up until the moment reality catches up. And reality in this case has been pre-announced by the SEC, by Bank of America, by BlackRock, by Ripple, by the on-chain data itself. The question is not whether the repricing happens. The question is who will still be holding when $2 becomes the floor instead of the ceiling. While the masses are focused on the candle, the smart money is focused on the calendar. Make sure to like and subscribe, and drop a comment below with your opinion on XRP. Price is a distraction. Structure is the reality. What Paul Atkins said this week was not a prediction. It was a deadline. And the institutions that operate inside the regulatory perimeter heard that deadline with perfect clarity, even if the retail market is still arguing about whether the clip was bullish. The math is fixed. The supply is shrinking. The catalysts are scheduled. The window is closing. None of this requires belief. It only requires attention. If you understand what was actually authorized this week, comment 2 years below. I want to see who is actually paying attention to the calendar instead of the candle. In a market fueled by emotion and noise, we thrive on data and composure.